For the last few months, Jerome Powell and the Fed governors have been talking up a storm about tightening monetary policy. This is the most hawkish Fed we have seen in a long time. But like I always say, forget what the Fed says and look at what the Fed does. So we're going to dig into these numbers and see, is the Fed really slowing their asset purchases like they're telling us, or are they all talk? Holding the government accountable. What a concept, right? What's up, guys? I'm Nobody Special, and the Fed has been incredibly hawkish lately. First, they announced they were going to taper their purchases of U.S. Treasuries and mortgage-backed securities by $15 billion a month. Then they upped it to $30 billion a month back in December. Then they started talking about rate hikes in March and then multiple rate hikes. Now they're even talking about rolling off the balance sheet at an accelerated rate. And they are just getting more and more hawkish every day. At least that's what they're saying. But I want to get into these numbers and see, are they really walking the walk here? Are they really doing what they say they're doing? Now, real quick, just for the folks who are newer here, since the start of the unfortunate health situation in 2020, the Federal Reserve has been engaged in quantitative easing, otherwise known as printing money and using that money to buy U.S. Treasury bonds and mortgage-backed securities. Now, that has two effects. The first effect is it keeps interest rates low. It is basically making it easier for people in the economy to borrow money. That stimulates the economy. Now, the side effect of that is it causes inflation. Well, lately, the Fed has been under a lot of pressure to start fighting inflation. So they've been weaning us off of this quantitative easing, otherwise known as tapering their asset purchases or slowing down the rate at which they buy these U.S. Treasury bonds and these mortgage-backed securities. Now, they're doing this slowly so that they don't shock the economy and do it all at once. So they started back in November. They said they were going to go from buying $120 billion a month in U.S. Treasuries and mortgage-backed securities combined, and that they were going to lower that amount by $15 billion per month until they got down to zero. Now, that means they're still printing money and they're still buying more. They're just buying less and less over time. Then in December, they came out and they doubled that rate of taper. They said they're going to slow their asset purchases by $30 billion a month. Again, they're still buying them. They're still printing more money. They're just printing less and less. So according to the Fed's own schedule, they should have bought about $90 billion worth of U.S. Treasuries and mortgage-backed securities in the month of January. So we're going to go to the Federal Reserve's website and see what they actually did. In particular, this is the St. Louis Fed, where you can see weekly snapshots of what the Fed is holding. Now, I don't have real-time data. All I can look at is the weekly snapshots. And at this point, we have data from January 26th going back to December 29th, so not quite the full month. And during that month, the Federal Reserve bought $63.9 billion of U.S. Treasuries. Now, the other half of the Federal Reserve's asset purchases is MBS, or mortgage-backed securities, otherwise known as mortgage bonds. And again, when we go to the St. Louis Fed website, we can see the weekly snapshots between January 26th and December 29th, and that during that time, the Federal Reserve bought $45.3 billion worth of mortgage-backed securities. So $63.9 billion worth of U.S. Treasuries plus $45.3 billion worth of mortgage-backed securities. That means in the month of January, the Federal Reserve bought $109.2 billion worth of assets. Now, they were only supposed to buy $90 billion worth of assets. That means the Federal Reserve is not keeping up with its own schedule to taper these asset purchases. They are still tapering, but they're not tapering as fast as they said they would. Had they been keeping pace with their own schedule, they would have only bought $90 billion last month. Now, why is that concerning? Well, take a look at this chart of U.S. 10-year Treasuries for the month of January, and you can see that those interest rates basically just marched up and to the right all month long. Interest rates have been rising fast since the start of the new year. Now, that's concerning because when interest rates rise too fast, the economy doesn't like that. We have a lot of debt. We have a lot of mortgages and loans and business loans and government loans. If the cost of servicing that debt rises too far too fast, you could create a tidal wave of insolvencies and defaults, and that could cause a stock market crash, a banking crisis, who knows what. So it's a little alarming to see rates in the treasuries rising this fast, even as the Fed is not keeping pace with the taper that they've promised. Now, the Fed has two choices here. They can either accelerate their taper to meet their own timeline, which would cause these rates to start rising even faster, or they can miss their deadline of being done with the taper by the end of March. And that would cause the Federal Reserve to lose credibility. Now, keep in mind, Federal Reserve credibility is vital right now. Now, the Fed may not have much credibility with me or with a lot of my viewers, but John and Jane Q. Public still trust the Fed for some reason and believe that they have it under control. Well, if the Fed is unable to meet their own short-term targets for reducing their asset purchases, that's going to cause loss of confidence in their ability to handle inflation. And that could cause people to start panicking and dumping their dollars, and that would make inflation a lot worse. That's a phenomenon known as a crack-up boom, a term coined by Ludwig von Mises to describe what was happening in Austria and Weimar Germany in the 1920s. That is a doomsday economic scenario, and we really can't afford to let that happen. Now, you might be wondering, nobody, if the Fed didn't even meet their taper targets, how come interest rates are rising so fast in the month of January? Well, take a look at this chart. This is the Treasury General Account. This is Uncle Sam's checking account. And look at that big spike in January. It seems that once the debt ceiling got raised back in December, the U.S. government went on a borrowing binge. They borrowed over $500 billion just in the month of January alone. So that is creating an increased demand for dollars, which is driving up the price of those dollars. The price of dollars is interest rates. So the government's appetite for borrowing money right now is forcing those interest rates higher. And it looks like that may have caused the Fed to at least ease off a little bit on their tapering of their asset purchases. Because if the Fed had tapered even more as the government goes on this borrowing binge, those rates would have shot even higher in January. And that would have caused the stock market to panic. We even had a little bit of panic in January, didn't we? It was a very volatile month. So now the Fed is behind the eight ball. They have to accelerate their taper to keep pace with their own deadlines. Otherwise, they risk losing public confidence. But if the Fed starts tapering even faster and the government doesn't slow down this borrowing binge, those rates are going to shoot higher. And I would call your attention to this chart that I've been showing over and over again on this channel. This chart that shows every time the interest rate on the 10-year Treasury goes above this purple line, something in the economy breaks and we get a major market crash. And right now that line is at 2.2% on the U.S. 10-year Treasury, and we're sitting here at 1.92% as of the making of this video. So if the government keeps borrowing at breakneck pace and the Federal Reserve increases their taper in order to preserve their own credibility, those rates could break that 2.2% mark in very short order here. And that says nothing about the interest rate hikes that the Federal Reserve has promised us in March. So long story short, no, the Fed has not kept pace with their taper. Yes, they have tapered, but not as much as they've been promising us. So their options right now are to accelerate the taper in order to catch up with the pace they've promised and risk crashing markets, or not accelerate the taper, miss their March deadline, lose credibility with the public, and risk making this inflation problem a whole lot worse. And you can see by that growth in the Treasury General Account that Congress and the Treasury Department are not going to make it easy on them, because their borrowing binge is putting a lot of upward pressure on those interest rates. And while we're at it, folks, why not put some upward pressure on that like button to help me out with the YouTube algorithm, and subscribe to my channel while you're at it. And if you want to know more about the impossible situation the Fed finds itself in, you can check out this video that I did with Mike from Rethinking the Dollar about how the Fed is forced to make a choice between hyperinflation or a stock market crash. Guys, thank you for your time. Thank you for watching this video. And until next time, live small and dream big.